financial information provided is not to be used for investing purposes. If you do wish to use any of the news or information provided, please seek a certified financial advisor or certified financial professional. John Galt, the host, JohnGaltFLA.com, nor TheWatchman.biz cannot be held responsible for investing decisions the individual or listener makes using the free information provided.
Welcome everyone to the Sunday Night Deathburger video. It is Sunday, March 13th, 2011. This is John Galt speaking. The news is about Japan, earthquakes. It is a disaster of unbelievable proportions. Pray for those poor souls over there as it's going to impact the world economy for time to come. It's also about Wisconsin, where the socialists have decided to show their ugly heads one more time. Let's get into the markets. Dow Jones had a disastrous week. This weekly chart on the 3 years with the candlestick shows that we had a nice big fat red candle to finish the week out. It does appear that we're not going to sit there and overcome the long-term resistance that was established many years ago, nor are we going to sit there and do anything to overcome the March 2009 lows. In other words, the bull market fail. We have major resistance above 12,600. As you can see from the red highlight there, we didn't penetrate it. We didn't give any kind of depth to it. We didn't get anywhere close to 14,000 on the Dow, even with all the trading and swapping of stocks. As the market went up, the volume deteriorated. As you can see in the bottom of the screen, this chart from Big Charts also illustrates that we are quite potentially setting up for a massive downturn. We could go as low as 6,500 easily and break our 11-year low. We'll see what happens. The Dow Transports also failed and had a big red candle a couple weeks ago, and then have been floating in Never Never Land, waiting to see what happens with the war in the Middle East with all the revolutions and stuff. This does not look positive either for the markets because it does not seem to have any kind of confirmed direction, although it did come close to getting back to its all-time highs. When you look at this, the failure to get above the 5,500 level with this double top does appear to be an epic fail. And that could be a crisis in and of itself. We just don't know how this is going to turn out when it's all said and done. When it sits there and you look at the next chart, the S&P 500, it's not much better. The S&P 500 had a big fat red candle also, and it does not appear to be gaining any kind of momentum to overcome its 2009 disaster. It looks like it's primed to roll over. And when you look at the S&P 500 over the long term since 1991, I'm going way back. There's a long-term, there's a double top apparently formed into it, and a long-term red resistance line there just above 1400 that I've highlighted. I don't think we're going to make it above that. I honest to God believe this is going to be a nightmare for this particular market to overcome, and I think it's a long-term 20-year resistance level. This major resistance around 1400 to 1590 isn't going to be overcome, and I honestly think we're going to roll over and tank. The Russell 2000 also had a nice big fed red candle, held the 50-day but barely for the week. I don't think it's going to sit there and stay there. I think the small caps are primed and ready to roll over as the oil markets are still quite unstable, and there doesn't appear to be any kind of support to indicate economic growth. Gold, however, did have a red candle last week, but held up nicely. Still apparently trying to form a new consolidation pattern at these higher levels, and that's why I think all of the market is concerned. Even though they're telling everyone there's no inflation and that gold is a loser, we just don't know what's going to happen next. Besides, when you look at gold compared to the Dow, well, it doesn't exactly look like it's fair. Also, when you look at it compared to the S&P, you heard the idiot on CNBC, "Oh, you better buy S&P 500 index fund for a hedge against inflation. Gold's a horrible hedge. Look at the returns." Yes, I see, plus 220% versus about 18% since 2004 when the GLD was created. The GLD is an ETF representing gold. When you look at the differential there, you look at the split, a 200% improvement over stocks, and this idiot is sitting here on television this week saying, you better buy stocks compared to gold. You really have to wonder what kind of stupid commercial hucksters or used car salesmen they're hiring. Let's compare the GLD to the Treasury. 10-year Treasury. Let's see, gold plus 220% roughly, Treasury down 20% in yield. Not a great bargain there. In fact, if you look at it, that's a 240% roughly increase or improvement in your investment compared to GLD. GLD compared to the Treasury. The 10-year Treasury is a nightmare if you'd bought it. If you'd bought this back in 2004 and gone with GLD instead, watching somebody else go with GLD, you'd have kicked yourself in the head. Versus one of the leading tech stocks, Intel. Intel is a loser, about minus 14% compared to plus 220 again. Once again, GLD is holding gold, or the GLD ETF, if you'd started buying it when it was created in 2004, is a much stronger investment for the long term. Yet people seem to think that there's no way it could sit there and fail. Folks, gold is a measure of real money, period, in a conversation. Unlike the big banks, which are conning you. Goldman Sachs, over the same long-term charts from 1999 to 2011, the start of the historic NASDAQ bull market till now, you see it got close to the resistance level of 195, failed, rolled, and has been stair-stepping down now for years. So despite the big rally since 2009 that's got Jim Cramer and all these boys excited, it's going the wrong direction. It's rolling over again, following a similar pattern to 2007-2008. JP Morgan did a little bit better, but it's doing the same thing. Never got above about the 54-53 level, rolled over, danced down, had the crash, got down to 15, rallied back up, has been consolidating. I bet you money it's probably going to sit there and follow the exact same pattern that the other major money center banks is, which is to roll over and crash and burn. Don't believe me? Look at this chart of Morgan Stanley coming up. It is a nightmare. Epic failure. Had this huge run during the 90s and early 2000s, crashed with the rest of the market in 06, and has never recovered the 38 level, and in fact is in the same process as Goldman Sachs after the recovery in 09. Rallied up, got stuck, didn't even make it to resistance, rolled over, has been stair-stepping down. Look for this sucker to crash and retest below the 20, probably below 10. Citigroup, it's just toast. The ugliest stock chart you've ever seen from 1999 until now. We're barely hitting $5 a share. No matter how much money the government puts into it, it's a nightmare stock. When I say it's toast, I mean it's toast. Break out the jam, break out the peanut butter, put your favorite topping on it. This is a company which should have been allowed to fail, but there's too many government interests in this, so they couldn't let it fail. Bank of America is the same way. Look at the three resistance lines. Look how far away it is from it. Didn't even get back to $30 a share, $28 a share, $43 a share, $38 a share, and $55 the all-time high. It didn't come anywhere. It's an epic failure. It failed on the recovery from the 2009 lows. It has got more problems than ever. They're putting everything into a bad bank, but it's going to get sued out of existence because of the corruption of the system the way it's designed. Intel, a long-term favorite and sweetheart. You hear every time Intel has earnings, you hear the CNBC money honeys going, "Ooh, look at this," and getting all excited. It's never recovered its resistance level of 36 from almost a decade ago, and it'll never see the days in its heyday in 99, 2000 of over $70 a share. Once again, when you compare it to GLD, what would you rather be in again? Yeah, that's what I thought. Let's look at the other big tech stock, Microsoft. Another epic failure. Never got back up to 38, never got back to 42, never got back to 60. Fluctuated, hit a level of just above 30, double top short term, rolled over, in the process of rolling over again. What it's telling you is that the investment strategy these con artists are telling you to buy and hold isn't going to work anymore. You have to be a trader. You have to know how to go short, no go long. Plenty of people to teach you how to do that. Not this program. But they're also telling you the overseas markets. The news was all happy, happy, joy, joy. Look at the great news from the Saudi market today. It was up a whopping 12 points, or 0.20%. Life is good. The Saudi stock market has recovered. We have to be happy about that because it means that the unrest in the Middle East has had no impact on our oil buddies at the House of Saud. And they try to tell you that this is an indication that this market is very, very strong, closing out just above 6,300. The truth? Well, let's look at the United Arab Emirates market. The United Arab Emirates, same thing, up 4.3%. Big headline today. It's looking better. It's looking strong. Is it? This is a one-day, one-week wonder as the governments buy stocks. The reality, 5-year chart. The UAE market's double-topped, failed, rolled over. We're never going to see the highs we saw before in the United Arab Emirates market. In fact, odds are it's going to deteriorate further as their banking system is only being held up by the government, and to make matters worse, their real estate system is still collapsing. There's been no improvement in the UAE or the Emirates for the real estate markets, and now they're having to borrow money and create money from Dubai and from Saudi Arabia and Qatar to sit there and prop up the poorer Emirates and buy the piece of the people. Saudi market, same thing. Look at this. You're never going to see 17,000 on the Saudi market again. And these people are saying how great, oh, look how great the Saudi market is. That idiot over at Business Insider has been proclaiming, oh, the Saudi market's recovering. Look how great this is. Dude, get your beer goggles off. This market 5 years ago was trading at 17,000. It can barely hold the 6,500 level, and every time it gets to about 7,000, it fails and rolls over again. Break out a long-term chart. Bahrain is in much worse shape. As you can see, it's below 1,000. It crashed. It's not coming back. There is no tomorrow. Bahrain is about to have Saudi National Guard troops cross its border, move into the nation to help support them against the Shiites. The Shiites are going to rebel in eastern Saudi Arabia, so now the House of Saud has made it and decided to cast its die. It is going to militarize the situation. So let's take a look at the tech stocks that everybody was talking about. The stocks got slacked. This is a 1-year chart of the stocks, the Philadelphia Semiconductor Index. You see we broke the 50-day moving average with huge volume, and now we're trading well below it. Slight bounce on Friday. I'm not impressed. We didn't recover the 50. The 3-year weekly chart also indicates a major disruption in the force, Luke. And I have the funny feeling that we're going to see this sucker start to roll over a little bit further. We might see a bounce. We might even hold up through the summer. But before this is said and done, it does appear to be on its way going downtown for a major crash and burn and a retest hundreds of points lower. The KBW KRX Philadelphia Regional Banking Index. The regional banksters are telling you the tale of the tape. It looks just like the big banksters. We didn't get back to the highs of old. We didn't recover back to the 2010 levels. We're in a negative consolidation with 3 nasty red candles. Huntington Bank on the long-term chart. To illustrate this, everything's from 1999 to 2001. Epic fail. Got up at around 34. Boom. Failed. Fell. Crashed. Burns. We've never seen a recovery back to the post-crash highs of 2009. Another stock that's in major trouble is SunTrust. Same story. Never got back to the 40-50 range, which was some sort of resistance level. Thought to mean something. Never came close. Got up to about 34. Failed. Rolled over. It looks like it's going to go downtown again, too. I guess all that real estate in Florida does actually mean something. Regions Financial never got back to the $15 level, which was the lower end of the resistance. It should have made that back if this was a true recovery. It failed. Another one, Zion Bancorp, never got back up above $32 a share. It's crashing and burning. These are very ugly stocks, but we do have a winner, IBM. IBM and its government contracts and internationalization has the Charlie Sheen winning thing all over it. So thank you for sitting here and showing that there are some stocks that can make it. Or is it because Wall Street's piling all its money into there? Well, one reason you don't want to is unemployment claims. This week we saw a spike in the non-seasonally adjusted unemployment claims, 52,000 up to 406. That'll be revised higher. What that's going to do is tell you that this lie isn't working about unemployment, and this guy's going to be chain smoking in a serious fashion. In fact, look, don't chain smoke, just have panic sex. I'm sure that's what he's doing. Next week we'll have a Municide update. There's a municipal bond crisis that's emerging. Meanwhile, stay tuned to the voice of Galt on the Watchman.fm. That's the Watchman.fm. Tune in to JohnGaltFLA.com for more. Good night. God bless.